Hello there and welcome to the look ahead for the week starting March the 3rd. Yes, we are heading into March. That's right, if we can't believe it. With me, Fiona Cincotta, Senior Market Analyst here at City Index. So just before we kick off, I'm going to ask you, as always, to quickly read through the risk warning. I will pop myself on mute. Excellent. So let's get straight in by having a look at some of the charts just before we take a look at the economic calendar as to what's going on for next week. I think just sort of talking about themes broadly, we are going to be very much still focusing on the prospect of trade tariffs. Obviously, we've got trade tariffs expected to kick off for Mexican goods and Canadian goods as from Monday. China is also expected to see another 10% increase on tariffs for goods imported from China. That's in addition to 10% that's already been applied. And also, well, Trump has hinted at tariffs on the European Union. So I guess we'll be watching out for any developments and concrete confirmation on those, though it may not come next week. All that we've heard from tariff is that he has said that this week that a decision had been taken and that an announcement will be coming soon on 25% reciprocal tariffs on the European Union. This we're looking at here is the S&P 500. Interestingly, this week we've seen a sell-off in US stocks. So even though Trump, has been very much sort of, we were expecting the deregulation and business-friendly Trump to help the US stock markets. Actually, whilst we did reach an all-time high, we have since seen the price fall sharply this week as concerns over trade tariffs and what that means for the inflationary impact on the US and growth, what it all means. We've had data in this week, both business confidence and consumer confidence has pointed to a deteriorating outlook. The PMI data last week was also weaker than expected. So not only have we got these concerns about trade tariffs, but there's also now concerns that they might be affecting the consumer confidence and business confidence, which could then, feed through into harder data, which will then sort of raise more concerns. But forward-looking data at the moment from the US is not encouraging, and that also is what's been sort of fueling the sell-off in equities. Interestingly, we have seen that the US dollar index has risen this week, recovered from that 11-month low that we saw earlier this week, and is rising. And basically, again, that's just on safe haven flows. The US dollar is proving to be the safe haven of choice. Obviously, in times of stress, cash is king, as they say, and that's really helped drive US dollar higher after 3 straight weeks of declines. So now looking ahead to next week, what we'll be watching, there's a couple of key data points next week. Obviously, as I said, sort of trade tariff stuff's also going to be in focus, as well as news surrounding any peace deal between Ukraine and Russia, but we'll come to that when we talk about oil. So I guess main focus for next week, 2 main focuses we've got, let's just have a look, I think will be ECB interest rate decision, which will be held on Thursday. And then we also have US non-farm payroll reports on Friday. Now, I'm just going to start with the US. Ahead of the US non-farm payroll report on Friday, we've got a couple of data points to be watching out for. ISM manufacturing on Monday, ADP payrolls on Wednesday, as well as ISM services PMI on then the non-farm payrolls on Friday. Now, as far as the PMIs are concerned, particularly the services, because obviously services makes up a large part of the US economy. US ISM services actually declined in January to 52.8. They were down from 54.1 in December. And that was well below expectations of a rise to 54.3. Now, whilst the sector expanded for a 7th straight month, the rate of expansion was clearly slower, and it came in weaker than expected. Now, as I said, forward-looking data that we've seen from the US recently has been weak. We also saw the services PMI fell into contraction on nerves by businesses. That was released a week ago today. Now, the market's going to be watching closely to see what extent the US ISM services PMI is being impacted by that deteriorating business confidence. Weak data could fuel those concerns over the outlook for the US economy and really take, send US stocks lower. And let's just take a bit of a closer look here at the S&P 500. Here we go. It's hit the all-time high there of 61.50, just below 61.50 on the 19th of February, and has fallen really quite sharply since we've taken out the 50 SMA, we've taken out the 100 SMA, we've taken out this level here, the 59.20 level, which we've been watching quite closely because, that had been proving to be a bit of a solid level of support. But no, that bearish engulfing candle has really aggressively ripped through that support. Now we're just steadying around this level here of around the 58.50 level. Sellers supported by the RSI below 50 combined with that bearish engulfing candle break below those levels there will be looking to take this to 57.75. That was the 2025 low. So that's the next level to be watching for on the downside. If we find for whatever reason there is a recovery taking hold, 59.20 on the upside is the level that buyers are going to need to get above to enter a more neutral holding pattern. But I guess really above there is the 6,000 level is where buyers will want to be looking to push above to feel comfortable and neutral. Now, the other one, so we were talking about non-farm payroll. Obviously, we'll get from the ADP, from the employment subcomponents of the ISM, services and manufacturing, we get some clues over whether the non-farm payroll is likely to beat or not expectations. Interestingly, the US labour market has showed actually quite remarkable resistance, even in the January report. Headline job creation was in at 143,000. This was a little bit below expectations, but we did see strong upward revisions to November and December's figures. Also, the unemployment rate fell to 4%, suggesting really that there's little urgency for the Federal Reserve to cut rates in the short term. Average earnings were also up at 4.1%, which is above inflation, level of inflation. So that's obviously, again, is going to probably mean that the Fed's main concern will likely remain on prices in their dual mandate. It's also worth noting, though, as I pointed out, those signs of weaknesses that we've been seeing in the forward-looking data. Jobless claims yesterday were the highest level in 5 months. So I think the markets are going to be watching these non-farm payroll report really quite closely for any clues over whether that weakness is starting to show through in the slightly harder data. If it does, then I think, as I said, we could see a sell-off in US stocks. Let's just take a look at the NASDAQ, which again has been hit pretty hard this week. Look at that. Really taken out some serious levels there, heading towards the 200 SMA. But look here, the RSI here is almost in overbought territory. So, we could see a little bit more of a steadying out at this price. Have a look at that candle there. It's a doji, so a little bit of indecision. But again, bearish engulfing candle breaking through several support levels that now become resistance as it heads towards that 200 SMA. It's pretty much been above the 200 SMA for a very long time, so it's actually quite a key support. Look, it offered support in September 2024, offered support in October 2023. So you know, we've been above it really, apart from a very brief spike lower in August 2024, but we've been up it since January 2023. So a break below that 200 SMA would be fairly significant. But it's worth just having a look. Look, the price does respond to the RSI. When we see the RSI move into oversold territory, we do tend to get a little bit of a rebound in the price. So that's something worth keeping your eye on. So sellers at these levels should be a little bit cautious. If we get a break below that 200 SMA there at 2,350, then that could fuel a steeper sell-off down towards 20,000 and even then lower towards, you know, 18,200. But if we find that we're getting some resistance, some steadying out here because of that oversold territory, on the upside, watching out for 20,800 and then 21,000 on the upside. If we get back here, then we're back into that sort of holding pattern that we've sort of been in for quite a couple of months. On the upside, there's the 50 SMA there at 21,500 to also be watching out for. Interesting also when just thinking about US, the health of the economy, what the Fed is going to be doing. At the moment, the Fed is expected to cut rates. I think the market's looking at around 2 rate cuts this year. That's up from previously 1, as we've seen this weakening in the data. Now, this is US dollar, Japanese yen. Obviously, it tends to respond really quite sensitive. It's quite sensitive to the US Treasury yields, 10-year yields. But also Japanese data, but that's the reason that we're seeing this jump up today as well. We've seen a rise across the last few days where we've seen that the US dollar is actually that safe haven of choice amid the Trump trade tariff saga. But still, the yen has found some support from expectations that we had seen rising expectations that the Bank of Japan would be cutting interest rates. Not too much on the data front from Japan next week, so might find that if we see a continued risk off, that will be watching for a rise above this level here, 150.80. That's the 50% retracement from the 162 high, 139.50 low, and above there we've got the 200 SMA. First of all, the 200 SMA at 152.45. If we get weak data, weaker than expected US data, it's interesting to see how this will play out, because if we get weak data next week, then will that fuel concerns over the health of the US economy, in which case that could drive safe haven gains in the US dollar? Or will it fuel worries over and that the Fed will need to cut rates more, in which case the dollar could fall? It'll be a good indication to watch the core PCE data today to see how the dollar responds to that, because if we see that it comes in weaker than expected and the dollar rises because of those safe haven fears, then maybe we could expect a similar reaction next week. So that'll give us some clues over how concerned the market is over the outlook for the US economy. Just finally, I think the other one, whilst we're talking about trade fears, etc., is gold. So this is gold, first down week in around 9 weeks. It's had a phenomenal rally from across 2025, hitting that all-time high just at the start of this week above 29.50. Pullback, is it something to be worried about? No. I think that given safe haven demand, given expectations that the Fed will be cutting interest rates over the coming year, I think demand for gold remains solid. There's a lot of demand for physical demand in the US that we're seeing. So that safe haven call is keeping the demand for gold supported. So I think, you know, a pullback is completely within expectations. It's had an extremely solid rally up. I mean, it would take a fall below this level here, 27.90, for me to feel sort of concerned about gold, in which case, but I think, you know, given that it rebounded off 28.50, if we can get a rise back above 28.80, that will take us back into a more neutral territory. In order to get a higher high, we need to be above 29.50. That will obviously bring 3,000 into focus. I think we might be a little bit some way off there yet, but even if we get a break below 28.50, that could then open the door to the 27.90 level. But as I said, you know, going to be watching the data from the US. We do get a stronger US dollar as well. That could hinder a little bit any recovery in gold. So next thing to be watching is ECB meeting. That is on the Thursday. Now, ECB expected to cut interest rates again in March. They cut rates, let's remember, in January. The central bank was one of the first major central banks, or the first major central bank to start its easing cycle last June, and has actually cut rates 5 times since then. Now, it's worth remembering that inflation has ticked higher from the 1.8% that we saw in October last year. It's currently around 2.5%. We do actually have Eurozone inflation data, which is also due out next week. It is due out ahead of the ECB meeting. I think it's actually on the Tuesday or the Monday. There we go. So, I mean, I think the data is likely to reinforce the stickiness of inflation in the region, but it's not really likely to have much of an impact on the ECB rate decision. You know, I think policymakers will be more focused on trying to promote a recovery in the economy, given the weak economic outlook that we have. I mean, even though the ECB have cut interest rates 5 times, you know, the German economy still remains very depressed. You know, it's contracted. We saw that it contracted again at the end of 2024. However, there is this sort of, I think the ECB and policymakers are getting a little bit closer to the level where they may need to consider a pause. I say that because obviously inflation, as I mentioned, is sticky, proving to be a little bit sticky, ticking higher, and you know, that is a reason that the central bank can't be cutting interest rates, although, as we've pointed out, the economy is showing signs of weakness. Now, the market is expecting 75 basis points of rate cuts this year, and the policymakers will also publish a review of estimates of where they think the neutral rate is. So that will be interesting, although I think with the prospect now of trade tariffs from Trump, that could, you know, could impact inflation. Policymakers may be interested in taking a slightly more cautious approach following this meeting. So yeah, you know, we're expecting a rate cut 25 basis points. I mean, the ECB haven't been necessarily guiding anyway, but I think they will potentially want to turn a little bit more cautious if there's, you know, concerns of trade tariffs, which might add to inflation, but also may weaken growth. So, you know, fears of stagflation may be rising. Now, this is the Euro US dollar. We can see that bearish engulfing candle there. That's when Trump announced that the trade tariffs on Mexican goods and Canadian goods will start as from Monday. Obviously, it raises the prospect of trade tariffs on the European Union also going ahead. I think, you know, up until then, there had been this idea that, oh, maybe, you know, this is just negotiation tactics and they may not go ahead. And I mean, there is still time over the weekend. Who knows what will happen over the weekend? Will they get delayed further? Obviously, if that does happen, we could see a strong recovery, particularly in the euro, the Canadian dollar, and the Mexican peso, and just risk sentiment broadly. But yeah, I mean, the weekend sometimes a long time under Trump. But so, you know, just going ahead with this idea that trade tariffs will kick off. On the support on the lower side, if we get sort of signs of, or we hear that the ECB is sounding a little bit more cautious, or if we get weaker than expected inflation data, watch out for this level here. It's being tested 104, 103.90. That's the 50 SMA and also the round number. If we get a break below that, then I'm watching out for 133.40. That's the November low. Before sort of we look towards the 102.50 level and 102. So there are quite a few levels to be watching for on the downside, but first we'd need a break below that 50 SMA in order to get further losses. On the upside, if we find that that level holds, so if we find that the ECB, for example, start to sound a little bit more hawkish and cautious over cutting rates further, then that could offer some support to the euro, especially if we get weaker US data in, or an improved mood, which drives out sort of, you know, safe haven outflows. Then on the upside, watching for 104.50 as a round number, and then the 105.30 level. This is a level that the market failed to rise above. Now, we do just need to watch out here. Could this be a double top formation? Doesn't look like it at the moment because we're being held up by that 50 SMA, but a break below there could sort of start things to look like a double top, in which case, watch out for the 103 level on the downside. Just going to have a look at German, the DAX, in light of all this, in light of the trade tension, the ECB, the German inflation data, which is coming out shortly. This is the DAX. Now, it rose to that all-time high just below 23,000 in mid-February. Fell off, found support on the rising upper band of the rising channel, which is more or less where it found support again today. Does it manage to hold above that channel? That's what we'll be watching for. And if it does, then that does mean that on the upside could be looking towards a break back up towards the 23,000. If we get a break below 22,150, that could create a lower low, and that would change a little bit the structure of the market, potentially opening the door to a steeper sell-off to 21,500 and below there 21,000. So just for the moment, it's relatively neutral. We've got the RSI well above 50, but yeah, so that's going to be a level to watch out for in order to get a lower low in place. Okay, so what else have we got? China. Let's talk about China. We've got a lot of data. We've got PMI data coming out of China across this weekend. We've also got, I mean, look at that, that's stunning. What a rally. It's gone back above there. So there we go. Testing that resistance as we speak. Basically, what have we got from China next week? We've got from China the China 2 sessions, which is going to be really interesting because this is a meeting where investors will be paying close attention really to China's 2025 growth targets and also top level policy priorities. Japan is expected to stick to the around 5% GDP goal this year, which will be the same as last year, and there could be more details over the direction of fiscal and monetary policy. On the data front, as I mentioned, we've got official PMI data to be released over the weekend, with both services and manufacturing expected to tick 0.1% high, well, 0.1 higher. However, the cakes in manufacturing and services PMI will be released during the week. Now, Caixin data last month showed that Chinese factory and services activity growth slowed in January. So the market's going to be watching to see whether that continues. This market has clearly not been impacted by heavily by concerns over the 10% trade tariffs. I mean, we did see a bit of a pullback on well, that's today that we're seeing that, but broadly speaking, you know, it's been in a solid uptrend, the Hang Seng. So I mean, what we're going to be watching out for here, we're obviously having this fall lower again after such a rally high, and not something that I think is particularly concerning. On the downside, just be watching out for 22,000. That's going to be a level. We've also got this one here, 22,500, which was the low from the 20th of February. So, but I think, you know, it's really going to take a move below 21,380 to negate that near-term uptrend. Not looking for a lower low until, so, you know, we get below this level here, 18,600. So you know what, I think that's a fairly solid move higher that we've seen there. So again, on this data front, if we get weaker than expected data, then that could see a further decline. I mean, whilst the Hang Seng is down around 3% today, but actually it's up 13% across the month. So, you know, really strong gains there. And I think just finally, the last one that we're going to be watching out for is oil. Okay, it's back. Oil's been in this downtrend. It's obviously, we've had these problems. A couple of problems as far as oil is concerned is the peace deal or potential peace deal in Russia, between Russia and Ukraine, which could see sanctions on Russian oil removed, and that would increase supply to the market. That would been putting pressure on oil prices. Obviously, you know, Trump and his drill baby drill has also sort of, you know, got the market a little bit concerned about increased supply, and then add into that the trade tariffs and concerns about the outlook for the trade tariffs will be, you know, what that'll mean for global growth. On the upside levels for global growth, what that means for growth and potentially a slightly weaker demand outlook. On the upside, we'll be looking at a rise above the 70.50. That's the high of yesterday. We can get above that level, then it'll bring the 100 SMA at 71, and then this one here up at 72.80, which is also the 50 SMA. On the downside, if we get a break below 68.50, that's going to create a lower low and open the door to this support zone here around the 66.50 level. So that is everything from me. I hope that you have enjoyed the session, and I look forward to seeing you again next week.